Oil prices aren't just numbers. They shape your daily life in ways you might not even realize. Every time you step outside, drive to work, or shop for groceries, oil prices are quietly influencing your choices and your wallet. When oil prices rise, filling your gas tank costs more, but the impact goes far beyond the pump. Higher oil prices ripple through the entire economy, making transportation, shipping, and even heating your home more expensive. Businesses that depend on transportation, like trucking and airlines, see costs climb and pass them on to you. Delivery services, ride shares, and even your next vacation flight all become pricier as companies adjust to higher fuel bills. That means groceries, electronics, and almost everything you buy gets more expensive. The cost of moving goods from factories to store shelves is built into the price tag, so when oil goes up, so does nearly everything else. Every product's journey, from raw material to store shelf, relies on oil at every step. From the plastic in your phone to the food on your table, oil is a hidden ingredient in modern life, powering factories, trucks, and ships around the globe. High oil prices squeeze business profits and family budgets, acting like a tax on the global economy. When energy costs soar, companies may cut jobs or raise prices, and families are forced to make tough choices about spending. When oil prices fall, it's a relief. Gas is cheaper, and you have more money for other things. Lower prices at the pump can mean more family outings, extra savings, or simply less stress about monthly bills. Lower energy costs help businesses too, sometimes leading to lower prices or more jobs. Companies can invest in growth, hire more workers, or offer better deals to customers when their own costs drop. But very low oil prices can signal a weak economy where demand is down. If people and businesses aren't using much energy, it often means growth is slowing, jobs are at risk, and confidence is shaky. Understanding what drives oil prices helps us anticipate economic shifts. Oil is a global commodity affected by politics, technology, and even weather, so its price tells a story about the world's health. In 2026, two forces are set to collide: U.S. political changes, possibly under Donald Trump, and a surge of new oil supply worldwide. Elections, new policies, and international agreements can all send shockwaves through the oil market. How these forces interact will shape oil prices, affecting economies and households everywhere. The choices of leaders, the pace of innovation, and the balance of supply and demand will all play a part in your daily life. This video will break down these dynamics and what they mean for you. We'll explore how oil prices are set, who the key players are, and what you can expect in the coming years. Oil prices are more than a headline. They're a signal for the world's economic health. They reflect the push and pull of global events, and their movement can be a warning or a sign of opportunity. Whether you're a business owner or a consumer, oil's story is your story too. The price of oil touches every corner of your life, from the food you eat to the job you have. Let's dive into the forces shaping oil in 2026 and discover how this powerful commodity will continue to influence our world and your future. A possible Trump presidency brings a fresh wave of uncertainty to the oil market, stirring up questions about the future of global energy. Investors, analysts, and industry leaders are all watching closely, trying to anticipate what changes might come. The oil market, already sensitive to political shifts, could see even more volatility as new policies are debated and discussed.
If tariffs and tough trade policies return, global trade could slow, reducing oil demand. The flow of goods across borders might become more expensive and complicated, impacting everything from manufacturing to shipping. This slowdown would ripple through the energy sector, as less trade means less need for fuel to power ships, trucks, and planes.
Trade uncertainty makes businesses cautious, delaying investments, pausing expansion plans, and waiting for clarity before making big decisions. This hesitation affects hiring and production, as companies try to avoid risks in an unpredictable environment.
A slower economy means less travel, fewer business trips, and reduced movement of people and goods. All of this leads to less fuel use, putting downward pressure on oil prices and squeezing profits for energy companies.
Oil prices depend as much on future demand expectations as on current supply. When uncertainty clouds the outlook, markets can swing wildly on rumors or policy announcements.
Even the threat of tariffs can make traders bet on lower prices, causing volatility. Unpredictable headlines and sudden policy shifts can send shockwaves through trading floors worldwide.
While Trump might boost U.S. oil production, Weaker global demand could push prices down overall. The US could become a bigger player in oil exports, but if buyers overseas cut back, the benefits may be limited.
The political climate in Washington will be a key factor for oil in 2026, shaping regulations, trade deals, and the overall direction of the energy sector.
The mere prospect of new trade policies could keep the market on edge and prices volatile, as everyone tries to guess what comes next. Political decisions will ripple through the oil market, shaping business sentiment and global trade. Every announcement, negotiation, or tweet can have immediate effects. The world will be watching and reacting as the next chapter of oil market uncertainty unfolds.
A US-brokered peace in Ukraine could reshape global energy flows overnight.
Peace would likely restore Russian oil exports, increasing supply and pushing prices down. Russian refineries, damaged by war, could be repaired, bringing more diesel and crude to market. Lower diesel prices would reduce demand for crude, removing a key support for oil prices.
BMO Capital Markets sees this as a major downside risk for oil in 2026.
A single diplomatic move could erase the risk premium that's kept prices high. The Russia-Ukraine conflict isn't just a headline. It's a central variable for oil prices. A peace deal could trigger a sudden significant drop in prices. The market is watching this closely.
US policy toward Venezuela is another wild card. For years, strained relations and strict sanctions have kept Venezuelan oil largely out of the global market, limiting options for both the US and international buyers. But now, with energy security a growing concern, Washington is rethinking its approach. Easing sanctions could unlock Venezuela's vast oil reserves, adding more supply to the market. Venezuela holds some of the world's largest proven oil reserves, and even a partial return to global markets could shift the balance of supply and demand. US Gulf Coast refineries are built for Venezuela's heavy crude, so more imports would compete with Canadian oil, pushing prices down for both. This could offer American refiners more flexibility and potentially lower costs for consumers at the pump.
Beyond immediate exports, foreign investment could return, rebuilding Venezuela's oil industry and boosting production over time. International companies might bring in new technology and expertise, modernizing aging infrastructure and increasing output.
This wouldn't happen overnight, but the prospect alone would weigh on prices. Even the anticipation of future Venezuelan supply can influence how traders and analysts view the market today.
Unlike a Russia-Ukraine peace, a revitalized Venezuela would add a new, long-term source of supply. This could help stabilize global oil markets and provide a buffer against future disruptions elsewhere. Traders would start pricing in higher future supply even before new oil hits the market. Expectations alone can drive volatility, as markets react to every policy signal and headline.
A shift in US-Venezuela policy could reset market expectations for years. It's a move that would ripple through the energy sector, affecting producers, refiners, and consumers worldwide. The possibility alone is enough to move prices. Markets are always forward-looking, and even rumors of change can spark significant reactions. Watch this space in 2026. The story of Venezuela's oil comeback is just beginning, and its impact could be felt for years to come.
In 2026, a wave of new oil supply is coming, regardless of politics.
This surge is global, mostly from non-OPEC countries, thanks to years of investment now paying off.
The International Energy Agency expects a big jump in supply, especially early in the year. Think of it like a bathtub filling faster than it drains. Oil inventories will build up.
Rising inventories almost always mean lower prices.
Even with healthy demand, the sheer volume of new oil will cap prices. The first quarter will see the biggest impact, as new projects ramp up just as seasonal demand dips. The market is bracing for a period of too much oil and falling prices. The US, Brazil, and Guyana are driving this non-OPEC supply surge. US shale fields keep output high with new tech and efficiency.
The US is now the world's top oil producer, able to ramp up quickly. Brazil's massive offshore fields are coming online, adding steady, long-term supply.
Petrobras leads Brazil's charge, while Guyana's rapid rise is reshaping the energy map. Guyana, once a non-producer, is now a major player thanks to huge offshore finds.
This trio's growth challenges OPEC's ability to manage the market.
Non-OPEC producers will keep pumping as long as it's profitable, regardless of OPEC's moves. The Americas' relentless output ensures a well-supplied market and limits price rallies. The balance of power in oil is shifting.
OPEC Plus faces a dilemma as non-OPEC supply surges.
Unwinding production cuts adds more oil to an already saturated market.
If OPEC Plus pumps more, prices fall. If they cut, they lose market share to the Americas.
There's also debate about OPEC's real spare capacity, the world's safety cushion.
BMO says official spare capacity numbers are overstated. Most members are near max output.
Only Saudi Arabia and the UAE have meaningful spare capacity left.
BMO estimates true spare capacity could shrink to just 1.4 million barrels per day, a thin buffer.
This hidden fragility could set the stage for a much tighter market later in 2026. If a supply shock hits, prices could spike fast.
2026 will be a year of two halves for oil. The first half, oversupply from the Americas and OPEC Plus unwinding cuts, means weak prices.
Analysts see U.S. crude, WTI, trading at $55–60 per barrel, with lower gas prices for consumers.
Geopolitical moves, like peace in Ukraine or a Venezuela policy shift, could push prices even lower.
In the second half, the supply wave slows and attention shifts to OPEC's shrinking spare capacity.
As demand catches up, the market tightens and prices recover.
BMO predicts WTI will rise to $60–65 per barrel later in the year.
With little spare capacity, any supply shock could send prices soaring.
2026 will move from abundance to scarcity, fast. The oil market's mood will shift dramatically.
The 2026 oil market will be shaped by politics, new supply, and fragile capacity.
Early year abundance means lower energy costs, but risks lurk beneath the surface.
US political moves, peace deals, or Venezuela policy could all shift the market overnight.
As the year goes on, focus will turn to OPEC's thin safety net and the risk of sudden price spikes.
Navigating this market will require vigilance from policymakers and businesses.
Oil prices will be a key signal for global economic health and stability. Understanding these forces is essential for smart decisions in a volatile world.
In 2026, today's oil glut could become tomorrow's shortage. Stay alert.